Hello, everybody, and welcome to another edition of ATLalts. This is your host, Andres Sandate, and I am joined today by Ben Leybovich of Whitehaven. They are a multifamily investment sponsor headquartered in Phoenix, Arizona. Ben and I are going to spend about the next hour talking about why Phoenix, Arizona, why multifamily. Of course, talk about Whitehaven, why Whitehaven, and really dig in today on ATLalts and talk about the opportunities and the unique macro backdrop of multifamily. So, welcome to the ATLalts podcast, Ben.
Thank you so much, Andres. Happy to be with you.
Yeah, glad to have you here. I know we've been working on this recording for some months, and I want to give a shout out to our mutual friend, Mark Zuba from Pinnacle Capital Group in Long Beach, California, who I met with my partner from Gramercy Park Wealth Advisors at the FactRight conference back in the fall of last year. So that dates back to, I guess it was probably September. And I approached Mark at the conference because I thought some of the offerings that they were representing, including Whitehaven, were quite interesting. There's obviously a lot of real estate in client portfolios when you talk about alternatives and you talk about where does an investor first start to get exposure after stocks and after bonds and cash. And a lot of investors, that are in a position to invest in alternatives and private markets, often there's a real estate allocation. So I thought what you guys were doing was interesting, and we're going to spend most of today allowing you to tell us about, again, multifamily, Phoenix, the opportunity, et cetera. There's so much to cover, but I want to make sure our listeners understand a little bit about ATLalts. I started the podcast. I'm a financial advisor with Gramercy Park Wealth Advisors, and the whole point of our show is to educate, inform, and hopefully inspire investors to expand their investment allocations outside of stocks and bonds. And we do that by inviting guests like Ben and Whitehaven onto the show to provide insights, analysis, and perspective within their very specific area of expertise, in this case, real estate and multifamily. So I would encourage those listening to share this podcast with their friends. We're out on Apple Podcasts, Spotify. We have a Substack now where you can find us at ATLalts. Of course, you can find us up on our website at ATLalts.com. But again, today's show is all about education. It's all about helping you as an investor, an advisor, maybe implementing alts into your practice to understand the opportunity that alts and private markets present. Today's conversation is going to be focused again on multifamily. So I'm glad to finally get to starting to talk to Ben and interview him and ask him questions. As I said, we welcome Ben. He's in Phoenix. So let's jump right in, Ben. One of the things at ATLalts that we love to do is invite sponsors like yourselves onto the show and ask you, to give some background and what you're doing at Whitehaven and why you're so excited about multifamily. So let's start at the top. An investment sponsor is usually comprised of a core group of partners that make up the GP, that make up the general partner. So tell me a little bit about yourself and your background. How did you get to forming Whitehaven?
So, thank you again for having me. First of all, there
Yeah.
are two partners, senior partners, with myself and Sam Grooms. And it's very interesting. We're complete opposites. So, I'm a violin player by trade. I played violin since the age of 4. I was born in Russia. I came to America in 1989. I went through the entire process of citizenship, which is fantastic. I went to a conservatory at Cincinnati Conservatory, which was at the time one of the best conservatories in the country. And then I decided to start making money because I realized being a violinist doesn't exactly pay, right? So I started buying small, houses and duplexes and fourplexes and tenplexes. Long story short, I relocated to Phoenix. I wanted to grow in this space. After about 10 years of doing it, I started in 2006. I relocated to Phoenix in 2016, and that's when Sam and I joined forces. So Sam is a Deloitte guy. He's a classically trained CPA with SEC reporting background guy, complete opposite, right? So I grew up in the trenches, knowing what it's like to get a call from a tenant, hey, my alternator broke down. I can't pay rent because I got to get to work. So I got to replace my alternator. So I know those dynamics on the ground that you have to deal with when you run real estate. What I didn't know is how the numbers are stacked on the page. And that's what Sam brings to the equation. So it's a complete opposite. We had to learn a lot from one another and kind of segregate our opportunities based on our skill sets.
Yeah.
So we
When did you
launched.
launch let me ask you for, yeah, wait, I'll go ahead and jump in. When did you launch Whitehaven?
So we started as a JV
Okay.
between his company, my company, in 2018. And I believe the first 3 acquisitions maybe were done that way. And then Whitehaven as a thing came into being, I think, in 2019, 2020,
Okay.
that time frame.
Yeah.
So, I don't know if I, in my mind, segregate the first 2 or 3 acquisitions from everything Whitehaven has done because it's the same strategy.
Yeah, I was going to say a lot of sponsors will get started, in this fashion, right? If you go and look at the history of a lot of even publicly traded asset managers, if you could trace back the lineage and the founding story, a lot of times it starts with starting the firm with a few deals, right? A handful of LLCs. In the case of real estate, typically you buy an asset, multifamily, and you go out and raise capital from a handful of investors. Typically, they're all accredited investors, and they contribute capital. You and your partner run the investment, if you will, and hopefully return capital. And then that gets you to deal 2 and deal 3. And at some point, it sounds like you guys elected to form this management company, if you will, and start to bring the whole business kind of together in a more formal manner. Is that fair?
It was almost like when we realized we needed to hire people to help us, but
Okay.
we needed an entity to hire them into.
Yeah.
And so Whitehaven serves as that, like you said, asset manager slash
Yeah.
invest platform for our investors. But each acquisition goes into its own LLC, which is
Sure.
comprised of a number of its own separate LLCs for GP, LP,
Right.
all that stuff we can talk about.
Right. Now, let's talk about Whitehaven at a high level. I mean, you're experts in multifamily and you're focused, in Phoenix, the Phoenix MSA, let's call it, founded in 2018. So, one of the things I always like to ask sponsors is that background and your story. So you and Sam, your partner, have different backgrounds. Classically trained musician in your case, in his case, public accounting, CPA. You come together, you form the business. That's 2018. You set up in Phoenix, and so my first question is, why Phoenix? We're in the middle of spring training. A lot of people out in Phoenix right now, that are snowbirds, right? The beautiful
Right.
weather. I was there in the fall of 24. Hadn't been there since, gosh, the probably the early 2000s. I went to college at Arizona for a year. It's just exploded. I mean, literally has just grown exponentially in 20 years. But again, that's my experience. I'd love to hear you talk about why Phoenix, and why you guys are bullish on it.
So that's a lot of people's experience, actually, and it's also my experience. So um, I was investing in Ohio. I was living in Ohio with my family, investing, buying this small portfolio. Some of it I still own in Ohio, in a small town called Lima, Ohio. Wonderful town, wonderful people, but it's the opposite of a growth market. And the thing about real estate is you want to be in a growth market because rent growth happens in a growth market because supply can't keep up with demand over the long term in a growth market. So there's dynamics that are present in a growth market that you're just not going to have in a mature, stabilized market. So by about 2014, I made my last acquisition, which was like I think a 10 unit in Ohio, and I realized we needed to go. And so I stopped buying. My wife and I packed the kids. We traveled around. We looked at the Carolinas because
Hmm.
that's a good market. Obviously, we looked at Texas. Obviously, we looked at Florida. Obviously, we'll look at Atlanta, Georgia, because that
Yeah.
was closer to our, so we evaluated all the options. But every time I came to Phoenix, there's nothing else like it. There's
Yeah.
just it
Okay.
hits you in the head like this growth story. This I don't even know how to describe it, but you know when you are here that
Yeah.
you are in a place that's the Wild West in some ways relative to growth, right?
Well,
And
let's talk about that for a little bit. Like it's easy to read mainstream headlines and get excited about the growth that the mainstream media will throw out there, but there's factors behind that growth. To your point, people that have been there, have lived there, feel it, see it, experience it. Why? What are some of the things that are contributing to Phoenix beyond great weather, right? But there's got to be some other variables that are attracting people, businesses, and all the things that come with that to Phoenix.
well, I don't want to overstep any boundaries because I'm passing judgment, but I find this to be a business friendly environment.
Yeah.
Okay. As it relates to job growth, that's hugely important. It doesn't matter if your governor is a Republican or a Democrat. If they get out of town and go somewhere to get jobs to come in, doesn't matter to me if they're Republican, Democrat. That's their
Yeah.
job, and if they're
Yeah.
doing it, they're doing it, and they're doing it. So you might have heard this announcement. I think just yesterday, TSMC they were already putting in $65 billion worth of into a chip plant on the northwest of Phoenix. Well, Trump did this conference yesterday. They're putting an extra $100 billion. They
Okay.
just opened the first facility, which is a 12 billion, they say, facility. So they have another $150 billion they're going to spend over the next probably 5 to 7 years. Think of the jobs. Think of the level of jobs. That's not people making $30,000 that are coming in. That's people making $100,000, $200,000 that are coming in, right? What does that do to rents? What does that do to real estate?
Yeah.
What does all that mean, right?
Right.
So
So it's
being
not just to pick up on that point. So, you see a lot of announcements about, for example, data centers being developed, and there's, headline in the Wall Street Journal today. We're recording this, March the 4th, 2025, and there's headlines about massive data center going up in Utah. Some of the largest construction loans that have ever been done by Wall Street banks. Not just Wall Street banks. That just Wall Street in general, banks nationwide lending into this asset class. But what you're saying is that they're going to be actually manufacturing chips. This is a Taiwanese company that's going to be coming in and putting 160 plus $billion in the ground to create the fabrication facilities, the office space, and all that goes with actually creating the chips here in the U.S. and in this case, Phoenix, right? So that's going to have the spillover effect to your point of what jobs, people
so,
needing
so
housing.
this transition from a purely kind of a manufacturing slash service economy to electric cars, electric batteries, chips, all of that was already evident in the
Yeah.
mid 10s, right? You could see that in 2016, 2018, 2020. They really learned coming out of the Great Recession what went wrong. They analyzed it. They made different choices about how they assess taxes, which is a huge thing for business and underwriting to be able to know that, right? Um, that's why I came here. That's why I
Okay.
chose Phoenix. Going back to the original question, like it was a boat that had its nose pointed in the right direction.
Right.
And
And not to get too deep into the local economy, but one of the things about Phoenix that I experienced growing up is, you would go to Phoenix, you'd fly into Sky Harbor Airport, and it would be, Mesa, Tempe, Scottsdale, Phoenix, the sort of 4 or 5 kind of well-known inner ring suburbs. Today, I, I mean, you have Glendale, you have Anthem, you have, and it's just expanded.
Buckeye.
There's no, right. There's so many communities. Talk a little bit about that expansion and how
So
that's
this
happened.
this is a prime. They call it the MSA, Metropolitan Statistical Area. They call it a
Yeah.
prime market at 5 million. We're there. We're at 5 million for the MSA. The
Okay.
latest projection I saw is that by 2030, we're going to add 1.2 million more people. Last year, 2024, was a slow year for us. I kind of have my guesses as to why, but we still gained 60,000.
Yeah.
And that was kind of a slow, very slow. And I think it's because a lot of people who relocated here for remote work were called back. And so while
Right.
people were still coming in, a lot of people left, and dynamically net, we ended up with 60,000 population growth. But usually it's 80, 90, something in that range. So what comes with population growth? Shortage of supply, residential, both apartments and houses.
Right. Right.
And we can talk about construction costs, which add to the kind of a supply situation projecting 3, 4, 5, 7 years out.
Yeah. So if you're a multifamily sponsor, multifamily developer like Whitehaven, you obviously, one of the big factors is you want to be in a growth market, to your point, right? And take nothing away from, I'm from Kansas, right? And you've got some roots in Ohio. It sounds like, I mean, certain markets, submarkets, tertiary markets in those states are growing, for sure. Not to disparage those states, but they're not growing as much or as rapidly as a market perhaps like Phoenix, right? So let's talk about multifamily within the context of Phoenix. So there's a lot of different areas you can invest in within a geographic area, right? There's self-storage. That's a play on the expansion of the market. You can invest in infrastructure. You can invest in multifamily in the housing. Talk about multifamily. It's obviously your roots and your background, but it introduces a lot of complexity, right? There's permitting issues. Construction's been difficult, right? Costs have risen, labor costs have gone up, interest rates. There's a lot to break down, so I don't want to pack the question too much, but you had to start somewhere. You guys started in multifamily years ago.
Mhm.
Talk about multifamily and why that makes sense as a space and why investors should care.
Okay. Multifamily makes a lot of sense because people need a roof over their head.
Sure. Yeah.
That's beginning the baseline premise. The last data point that I saw is that the delta between monthly cost of single family ownership versus rent, average rent, it's over $1,000. It's in Phoenix. It's about $1,100. So that makes affordability very challenging unless one of two things change. Interest rates come down dramatically, and I'm not talking 1 or 2%, dramatically, or housing costs come down dramatically. I do think interest rates are going to come down. I just don't see them coming down dramatically. We're talking 50 basis points, maybe
Yeah.
1%. We're just not talking about 3.5%. We're not going back there anytime
Yeah.
soon. Right? So,
Yeah.
that creates a real opportunity for multifamily in a growth market. If you have people coming in, but you don't have a lot of supply coming in, you're going to have rent growth. And that's what we want to achieve returns that we're looking for. Now, there's a dynamic that has been present coming out of the pandemic because of the supply chain issues. And we experienced that a lot because we're a heavy value add, in some cases, company. It's not all that we do,
Yeah.
but a lot of what we do is heavy, heavy value add, say $30,000, $40,000 per unit. We got everything and we rebuild everything. So we have a lot of construction exposure and sensitivity to what's going on in the pipeline, and we certainly felt it. So what happened historically in Phoenix, we build about 6,000 to 8,000 of new units historically. You're talking 2016, 2017, 2019. That's just what we did in Phoenix. Okay. And we
This is the
absorbed
whole market. Sorry
the
to interrupt
whole
you, but
entire
the
market.
whole market. So all sponsors, big publicly traded REITs, all the way down to
Yeah.
a smaller operator doing a new 25 unit apartment. Not that you see a lot of those, but you're saying about 6,000 units annually are being delivered.
About eight.
8. Okay.
Historically. However, what happened in the pandemic is a lot of projects got started and pushed back because of the supply chain issues. So you ended up with a dynamic where in 2024, we actually delivered a little over 20,000 units.
Okay.
in 2025. So we're compressing 4.5 years of deliveries into basically 2 years.
Sure.
That creates an interesting dynamic and the set of opportunities that are, we feel, a limited window of opportunities for new construction acquisition at a huge discount to replacement cost. And we can revisit that if you'd like. But the other issue is that because the construction costs have gone up so much and the interest rates are so high, nobody can afford to pencil anything. So there's a cliff. And once you get through the new deliveries and you absorb those units, there's going to be a shortage of supply.
Yeah.
And that is going to create excessive rent growth. So we're setting ourselves up for another cycle, unfortunately.
Yeah. Another cycle. Well, I think, I think one of the things that is really helpful about having guests on who are, obviously deep in their particular area, whether it's real estate or it's credit or it's, growth equity or private equity, is that we get opportunities to really dig in, with the second and third and fourth iteration of the question to really unpack what you just said. So let's go back to what you said before, which is, historically, Phoenix is attracting somewhere in the 60,000 to, call it 90,000, depending on what data source and what year. 60 to 90,000 new folks are moving into Phoenix, kind of net on an annual basis, right? They need a place to live. They want to be in the greater metropolitan area of 5 million people. So apartments are obviously a place where they're going to look, given what you talked about earlier, which is that affordability gap, right? I want to go buy a 3-2. I have one child, maybe a second on the way, but then I go down, try to get a mortgage, and all of a sudden it's like, I can't afford that payment. So we're going to go to an apartment for the first year or two, and then we're going to evaluate our options. There's not enough apartments is one thing that you just described. Is that correct?
So before the pandemic, the
Yeah.
statistics were that Phoenix needed 150,000 new apartment units
Yeah.
to accommodate expected population growth over a decade.
Yeah.
Hence, we're delivering 6,000 to 8,000 a year. We're always chasing that need with our
Right.
supply, and we're always a little behind. Hence, we've always had strong rent growth in
Right.
Phoenix.
And so then you went to, if I understood what you described, because of the forces of the pandemic and supply chain, we saw builders, developers, real estate, multifamily sponsors deliver a lot of units in a very
All at
compressed amount
once.
of time. 20,000, 25,000 units were all
Yes.
delivered. And as a result, instead of that being paced out, now the rent growth, as kind of a boomerang effect, we may start to see rent growth as that new supply is absorbed and was absorbed, that 20,000 plus units. As that boomerang effect takes place, we may see a scenario to this could be advantageous to an investor now, not somebody trying to rent an apartment per se. That's a whole separate podcast conversation. But somebody that's an investor in multifamily may be in a situation where it's like, okay, now we're going to see rent growth as that new supply was absorbed, and that could happen in what time frame you anticipate? If I'm looking
I
at the
anticipate.
dynamic.
So I speak to a lot of builders. I speak
Sure.
to a lot of very large builders. Think Toll
And again,
Brothers.
we're not offering investment advice. I always tell
Right.
people, listen to the show for education, for insights. It's no different than turning on, any Bloomberg, CNBC TV show and listening to somebody discuss what's going on in the market. It's just an
Right.
opinion. You should definitely consult with an expert, an advisor, a CPA, etc. But what we are discussing is a situation where we could see, from your point of view,
The
a pretty
dynamics.
favorable dynamic setup for an investor in multifamily in Phoenix.
Let me take a step back.
Yeah,
So for a merchant builder, for it to be worth building, they have to have a profit margin.
sure.
Today, if you ask a builder in Phoenix, how much rent growth do you need to experience in order to be able to capitalize an exit on your new constructed multifamily so that you can make a profit. They will tell you plus minus 20%. They need to see rents pop plus minus 20% from their level today. This is a systemic issue. This is why we're setting ourselves up for rent growth cycle, because rents have stagnated because we've been delivering so many units in such a short time. But that means builders can't make a profit. They're not going to build if they can't make a profit. So what's it going to take? 20% rent growth. How long is that going to take? I don't know, but they're not coming back in. If you don't bring in new supply, and TSMC announces another $100 billion worth of investment, your population is growing, but your supply is not past 2025, then your rent growth kicks in. It has to, because we need more units. But in order to have more units, we have to have more rent growth.
Yeah, so it becomes a whack-a-mole scenario.
Exactly.
And you can look at this from multiple angles. Again, ATLalts is all about helping investors, right, gain insights, education, and information around private markets and diversifying, right? So into alts. Again, not offering advice, just offering education. And one of the things that I love to do is I love to bring experts like Ben Leybovich from Whitehaven on to provide insights on areas of the market that investors just might not be getting exposure to, and ideas they may not get exposure to from their everyday advisor who's got them in, with all due respect, mutual funds and index funds. I'm in a lot of those things. We put a lot of clients in those things as their core allocation, but then we look, and we're not working directly with Whitehaven yet, but this is a process. We get to know a sponsor. We understand the dynamics. We get to know the team. And one of the things that I think investors can benefit from is just getting educated around the ideas out there in multifamily. Again, I think a lot of people read the headlines and they say Phoenix is growing. That's interesting. It's a data point. I went out there for spring break, or I took a guy's trip. We went and played golf. But if you want to actually go to the next level, which is how do I make money from all of the growth, all of this that's happening, you got to find a way to do that, and you got to find a way to access that space. And that's kind of one of the things that I'm most excited about, is sort of finding experts on the ground trying to make money in a risk adjusted way, guarding any losses, et cetera, and downside protection, but also looking for angles and niches and seams where they can deploy capital in a smart way. So we've talked about Phoenix. You've given the background of multifamily as the category. Now let's talk about, like, your all special sauce as an opportunistic real estate investor with those macro dynamics. You want to get up every day, and like most productive folks, you want to execute, you want to do deals, but you got to be smart with investors' capital. You
Right.
can't just be willy-nilly. And I think that being disciplined and having an urge to transact and do deals and put your client's capital to work has to also be balanced with being, you know, okay, just waiting, okay, just being patient. So describe, given the backdrop, how you're navigating, kind of going forward.
So we started in 2018 with Class C mid 80s construction in Phoenix. Now this is different in different markets. If you
Sure.
go to Ohio, mid 80s construction can still be Class A.
Yeah.
Phoenix is such a young town and it's such a fastly growing town that mid
Yeah.
80s construction is just Class C. Okay,
Sure.
we started there, and in we have we can't be blind to the cycle. You can only take what the market cycle gives you. Otherwise, you're trying to do a square peg round hole situation. So when we say opportunistic, that really translates to where's the market pointing us? Where's the real opportunity today? Not
Sure.
yesterday, not tomorrow, today. What's it look like today? So in 2018, 19, 20, the opportunity was heavy value add repositioning. And we can talk about the differences in that, but that gets into the nitty gritty of what we do. But essentially, you buy the property, you do the renovations, you improve the tenant profile, you sell the property. And it's a kind of a different feeling and acting asset when you're done from what you purchased in the first place. We started in the 80s. We sold out that entire portfolio by 2020. We transitioned into even heavier value add, but newer buildings, much better locations. This is classified as core plus. So mid 80s through mid 2000s construction. And then the dollars we're spending on renovations went up from about 15,000 to about 25, 35,000 on the average per unit. We're building clubhouses, spending $1.5 million, $2 million to renovate everything in the clubhouse. This property then essentially becomes competitive with new construction. Why did we do that? Because we recognized there would be a wave of new construction. And while there's still an opportunity, it has to be competitive against the other product that's going to be selling, that you're going to be competing against, right? Today, however, the definition changes again. Because the real opportunity may be to purchase new construction below replacement cost. So when we talk about deploying capital smartly, it may be value add in some cases, but in some cases it may be if you know that the builder is going to spend $300,000, $320,000 a unit to build this thing, and that they're not going to do it until they think they can sell it for $375 to $400 because they need that risk margin. They need the profit margin, right? They need the risk. But if you can buy it today for $275 or $300, you're buying it today at 25, 35% discount to replacement cost. And that may be the safest thing to do in this part of the real estate cycle. Now, once the builders come back in, what does that mean? That means they think they can afford to build and sell for $400,000 a unit, which means you probably don't want to buy there anymore. You want to buy something that's heavy value add, but your basis is going to be considerably lower than new construction. So it's a different proposition to the marketplace, right? So in everything we do, we're reacting to what the market is doing. Right now, we're in an environment where builders, merchant builders, have development loans that are 3-year loans. The net incomes are down because there's so much supply over the last 2 years. The incomes are down. They can't refinance. And so they're forced to sell at, hopefully to get their cost out, in some cases, even below being able to get their cost out, but certainly dramatically below where you would think replacement costs to be. And that may be the opportunity. So like right now, we're looking at 3 projects, a brand new construction that just finished lease up about 6 months ago, 5-6 months ago. We're looking at a 2016 building that's basically brand new, but probably about 50%, 40 to 50% below replacement cost. And we're also looking at a 1986 building that's an interesting opportunity because there's no new construction in that submarket. Okay, so where you can do the value add and you can get the value out of it right away. Yeah. So you have to be very cognizant of the cycle, and you have to be malleable with your thinking if you're going to be deploying capital throughout the cycle.
Yeah. One of the things that we see a lot of in Atlanta when you have a very attractive environment for deal making is you see a lot of multifamily capital chasing and not chasing, but pursuing, their sweet spot of deals, right? That fit their buy box. And I would imagine Phoenix is no different, right? The story is out on Phoenix. And so sponsors will flock to markets where they can deploy capital and where they see growth, right? And certainly some of the markets that you and your family explored, I think by all measures would likely, fairly be categorized as growth markets, the Sun Belt, Smile States, et cetera, as they call them. How do you compete for deals in an environment like this when, let's say, overall deal volume is down, deal transaction volume is down? A lot of capital has been raised. in the alts and private markets over the last decade. More and more investors are trying to get into private markets and into syndicated deals and into private vehicles. So you have all those as tailwinds for a sponsor, but then you've got to weigh that again against deploying smartly, not overpaying for deals. They
Right.
always say the maximum is you make money on the buy, right? Not on the sell. So talk about the competitive environment. And you gave those three examples, but do you run into a lot of competition? What's that competitive dynamic look like in this environment today
Sure.
out in
Sure.
Phoenix?
Well, if I may, let me take a step back. You mentioned all these other markets,
Yeah,
Carolinas, Georgia, Texas. There's a reason I'm in Phoenix. There's a reason I picked Phoenix. I'd like to take a minute to address that because I think it's important. It's why so much institutional capital is attracted to Phoenix. Phoenix is a lot more transparent than a lot of other markets. First of all, the weather. There are no natural events in
yeah,
Phoenix. What does that mean? That means much, much more controlled insurance exposure. And
sure,
I cannot overstate that. I
right,
mean, things in Houston, Texas that are costing $2,500 per unit to insure in Phoenix are costing $450. I mean, it's not even close. It is a huge thing in terms of operations. Okay. We already discussed the business friendly environment. Okay.
right,
Which, a number of these markets would fit into that, but certainly the insurance taxes.
yep,
In most municipalities, they chase purchases. In other words, you pay X amount, your amount of property tax is based on what you are paying. This is not the case in Phoenix. There's a statute in place whereby taxes cannot increase in the most basic words. I'm not giving it justice, but in the most basic sense, taxes cannot increase more than 5% per annum. Neither can the taxable value. And that is not going to be impacted by a transaction. So it doesn't matter what I pay for the property. This is a statute they passed, I believe, in 2014. They did it coming out of the Great Recession because they recognized they have to pay the firemen, they have to pay the police people, and they wanted to have a stable set of income from property taxes. They learned that when the valuations shoot up, you get a lot of money coming in, but when the valuations crater, you don't, and then you have to lay people off, and you can't operate the city when you lay these people off.
yeah,
So this was a
yeah,
very smart decision. So from an operations standpoint, the underwriting standpoint, this is huge because you never know what your taxes are going to be until they tell you. Not so in Phoenix. You know what they're going to be because it's the
got it.
law. Okay.
Okay,
So all of those are factors why there are many growth markets, but I picked Phoenix. This is why it's much more transparent for me to underwrite and to understand. Okay.
yeah.
Now, go ahead.
No, I was just gonna one other thing you hear a lot about is in real estate is cost of materials, cost of construction, cost of labor, all of these things as inputs to if you're heavy value add, you're going in, you're replacing kitchens, you're replacing bathrooms. It's not so much as a cap rate trade, right? If you will,
Right.
of buying a core asset and effectively renaming it and putting it in a big public REIT, and your investors expect like a 4% return.
Right.
With what you guys are doing, when I hear opportunistic and I hear value add or deep value add, if I'm the advisor to the client, I'm saying we are going to tie up our capital with the sponsor for a period of time. That could be, a year to buy the asset, a year to reposition or do the value add. You're not doing all 300 units at the same time. You're doing them in phases, right? So you're taking units offline, you're taking, a hit to your NOI, but you're adding those units back at a higher rent, right? So it's like educating the client. But talk a little bit about costs and labor. Do you have enough workers, to meet the demand for when the market, let's say, recalibrates, in the next 6 to 12
So
months?
Costs in Phoenix are higher than they are in most places in the nation.
Okay.
I couldn't tell you why. I just know statistically they are, and this is both labor
Yeah.
and materials.
Okay.
More so labor than materials, but both really.
Yeah. Yeah.
So to develop a new community in Texas, you'd probably be spending 260,000 in soft and hard costs before the profit margin risk premium. Just the
Per
same
door, per
per
unit.
door per door
Yeah.
per
Yeah.
unit.
Yeah.
Yeah. Now, I'm sure somebody's going to tell you, oh, I can do it for 180. Oh, I can do it for, talk to somebody
Right.
big, okay? Talk to,
Right.
to somebody
Yeah.
who's has the systems to be able to do thousands of units. They will tell you that this is
Yeah.
what the cost is. Now, in Phoenix, that cost is a little higher. It's probably about $50,000 higher
Yeah.
per unit. Okay.
So you have to account for that as an investor, as somebody deploying capital. Yeah.
Right, but the way it's accounted for is the cap rate.
Right.
The reason is Phoenix is a fairly low cap rate market. The market's been very disrupted over the last 2 years, but still, basically, quality product is not traded much above 5 cap. It's basically stuck at 5 cap, and historically, Class A and Core Plus is plus minus 4.5 cap in Phoenix. And so the window of opportunity here is if you can buy new construction today at discounted prices, when the cap rate returns to historical average, which is only 50 basis points down from where it is today, that's what we call in the business easy money. You just have to be able to finance it right and wait for a while for the market to kind of stabilize. But the reason it's a low cap rate market is because low insurance costs, low taxes, it's predictable market. There's less risk premium in this cap rate than Houston cap rate.
Yep.
Okay.
Makes sense.
Phoenix is such high growth population. I spoke a couple of weeks ago to a colleague of mine that has properties in Phoenix. In Houston. Vacancy in Houston, is 25% plus. Vacancy right now in Phoenix is 7%. In spite of the fact that we're absorbing 20,000 units per year, stabilized occupancy is at 93, 92, 93%. So institutional capital knows this. They want predictability. They want stability. They want growth. Now, the real opportunity right now is institutional capital is on the sidelines because they're waiting for a go ahead from the Fed. They're waiting for a complete green light. They need to check the box, which is our opportunity because we can be buying institutional product that we wouldn't necessarily have a chance to compete for if Blackstone, State Street, and all those guys were buying, and all of those guys are in Phoenix.
Yeah.
The other issue in Phoenix is that the average community size is very large. Unlike many markets where you see a lot of 40 unit, a lot of 80 unit, a lot of 100 unit, the average size in Phoenix is well over 250 units, which makes for an institutional check size. So when institutional capital goes on the sidelines because they like more stability with the 10-year treasury, with the Fed forward curve, with the SOFR forward curve. I understand that they have these boxes they need to check, but there's no buyers because the deals are so big, 80, $120 million deals. How many people can do that if the institutional capital doesn't come to play? So what does that do to the valuations? Circling back to the opportunity with new construction right now, because these builders built for the institutional capital to put into their REITs, into their funds, and that's not happening. And that's the opportunity for the discount today on new construction. Not to say that there isn't opportunity on value add, but there's just different shades of opportunities in this point of the cycle.
Yeah. Yeah. Let's talk a little bit about, the investments that you and Sam have made in the platform, right? So we we have seen a lot of sponsors through ATLalts that, they get to a point where they've outgrown what, the two partners, he and she, can do together, or the solo founder can kind of do on their own. And so you have to start investing in the business, right? Instead of just in the next deal. And all good sponsors, we're looking at and saying, how much of your capital are you putting at risk alongside our investors' capital? That's a key piece. But we're also underwriting the operations, we're underwriting the asset management, we're underwriting their capabilities, especially if it's a strategy where there is more of a roll up your sleeves approach, right? When you talk about value add, deep value add. So maybe give a sense for how you've built a team. What are the areas that you've invested in terms of personnel and trying to round out, the investment executive leadership
Sure.
acumen that you and Sam bring?
So we run lean. We don't have a lot of employees.
Yeah.
We outsource as much as possible. We learned by doing it the other way at
Okay.
first. So when we first started hiring, our perspective was, well, we can train these people. Let's just get people for a bit less money and we can train them. Well, we learned that doesn't work very well. You need to hire professionals who are better than you at everything you expect them to do, better than you could do. And forget teaching them. They will be teaching you how to do this. So in terms of employees right now, we have an asset director who is the liaison to the third party management, essentially. Underneath her, there is a construction manager. He's in charge of all of the construction in terms of liaison to all of the general, what's the word I'm looking for?
General
All of
contractors.
general contractors, all of that.
Yeah.
We
Yeah.
used to have guys in house on our payroll that would swing hammers. We
Yeah.
tried that. The
Yeah.
problem we found with that is that if one of them calls sick, then, like my tile calls in sick, tile guy, he pushes everybody else back 2 days. And that really has an impact on operations because in the entire ecosystem, the property hands us a unit to renovate. They want to know how to market that unit to be pre-leased. So they want to know when it's going to be done. So we have to give them the date. It's going to be done by such and such date. If we are 2 weeks late, then all of those costs that went into marketing the unit for pre-leasing, potentially they found somebody. This person wasn't willing to wait for another 2 weeks. Now they have to find a new person. It's just incredibly inefficient.
Yeah.
Now, the way to solve that is to hire two tile guys. So if one of them is sick, the other one can pick up. But that's inefficient on the other side of the deal because that drives construction costs up.
Yeah.
So what we eventually, after about 4 properties, what we eventually figured out is let's have a very high level construction guy that has worked both on the supply side and on the construction side, understands the both ecosystems and can put both of them together. Let's have him in house managing everything for us, but let's hire some very large general contractors with a lot of redundancy and a lot of capacity. So it wouldn't matter to them if they're doing 5 units or 35 units per month. They can do it. They have the manpower and the scale to do it. And let's have our guy manage them.
Okay.
And that's
Got it.
worked out very, very well because the cost increase is minimal, maybe. But when you think about us being able to turn units in 3 to 4 weeks, like clockwork, and the property gets the unit and the property can lease the unit, that's money the property starts making sooner. Okay.
Sure.
And then as far as property management, we thought about bringing it in-house. We just don't want to look at it as a profit center for Whitehaven because that's the wrong way to look at it. So really you got to look at, are the operations going to be any better? And you have all kinds of both accounting and legal and all kinds of things that Greystar can do with whatever, how many hundreds of thousands of units they manage that we cannot do. Not to mention talent, attracting talent. pay packages, all of those things, right? So are there some inefficiencies with third-party management? For sure. But there are also inefficiencies bringing this thing in-house, and we're kind of splitting the difference. We have a very high-level person in our business that essentially manages all of the third parties. So she has direct access to most of their books relative to our assets, direct access to regionals, to property personnel. She's over there all the time, and it works better that way. It keeps our payroll close by, so we don't have to feel the pressure to transact in order to support the payroll. On the other hand, we're still getting, we think, better property management. And listen, no property management is great. It's just
it's
is how it is.
tough. Yeah, you want your tenant experience to be as good as you can offer it. But at the end of the day, you're going to have some percentage in 100, 200, 300 unit, where you're just going to have stuff that breaks, and you're going to have to react, and you're going to just do as good as you can as a sponsor to make sure that you've got property management, whether it's in-house or external, that are responsive and are dealing with all the important needs, maintenance, security, all that. As we think about wrapping up the conversation, we've talked about why Phoenix, why multifamily. One of the core pieces of these conversations is the sponsor and how they sort of approach it. Last couple of thoughts. Want to give you a chance to sort of give a synopsis or summary of all the stuff that we talked about. There are a lot of things going on in our economy. There's a lot out there geopolitically. It can be quite distracting to an investor who's got a long-term orientation and a long-term horizon. What do we need to pay attention to, Andres? What are the things that we really need to be thinking about in our portfolio? And as their advisor, one of the things I'm always thinking about is, have a long-term orientation, right? Be long-term greedy, and in the short term, like, let's try to take the emotion out of it. Let's try to find sponsors who think similarly, that they're positioned and nimble to take advantage of opportunities, which is why we need to think about deploying capital to them. But we also, have to entrust them and give them time to deploy the capital so that we get a return on the capital, in 5 years and 7 years if we're going to tie it up. So with that as the backdrop, thinking about investors, how do you and your team sort of get excited about what's ahead, given this backdrop, given the macro? It's so much uncertainty, but at the same time, it's also normal, right? In a sense, we see this all the time.
What was that thing Warren Buffett says? Be fearful when everybody is greedy. Be greedy when everybody is fearful.
Yeah,
I mean,
right.
this is case in point, that situation, right? You, as an investor, you could write a check to Blackstone and invest in BREIT and call that a day. You're not going to get 12% IRR, 15% IRR, 17. You're not going to get it going that route, and that's where you guys come in with alts, because you have direct access to ground level opportunities instead of putting money into a fund that's very highly diversified. We are local. We are specialists in Phoenix. We live here. Our office is here. All of our contacts are here. We know the deal flow before most people know the deal flow. We have access to all of the brokerage community, both in terms of property and debt. We understand this market. We understand the growth story of this market. So many sponsors live in one place and invest somewhere else. That's okay, but you cannot do the kind of value add that may be necessary in order to make the investment perform well living somewhere else. Like, we are at the property every day. Somebody, it's either the asset director or the construction manager. Somebody from our office knows what's happening at the property level every single day. You can't do that. I couldn't do that if I lived in Phoenix and bought a property in Houston. So what
Yeah.
advantage do you get by
Yeah.
investing with me if I'm buying property in Houston? So the
Yeah.
ultimate commitment I made is, if this is a market I like to invest in, I'm just going to move here,
Yeah.
because then I
Just be
know
there.
what I'm
Yeah.
talking about,
Yeah.
right?
Be there. Yeah.
Um, so macro, I want to be very careful not to prognosticate. I'm not an economist. But still, you're kind of paying me to guide you, at least a little bit in some extent. I'll tell you, and this will get technical in a hurry, but essentially everything resides on the 10-year Treasury yield,
Right.
because most loans are based on Fannie Mae. Let's put it, Fannie Mae and Freddie Mac. Most of their loans are based on 10-year Treasury. So with the 10-year blowing out the way it did, that creates a problem. Now, a lot of loans are also based on SOFR, but that's also blown out because that tracks Fed funds rate.
Yep.
The real question we're all asking, you are asking yourself, I'm asking myself, is when's the 10-year going to come down? Like, we've been sitting and asking ourselves that question, because if everything starts with the 10-year and that's risk-free, then as an investor, do you really get paid to assume the liability and the risk of an investment if you can get your 5% and be done and just, live a happy life, right?
Yeah.
So at some point, that equation needs to change. If you ask me what I think it's going to come down, because I think inflation is going to come down, because I think shelter is falling like a rock, and we're tracking it, and it's approaching historical trend. So because that's such a big, like 40+% of core PCE, core CPI, I think my math is telling me we're going to be okay. The Fed is going to be able to come down twice. The market is pricing in more than twice in the last 3 weeks, but we'll see.
We'll see. Yeah.
That's a macro picture.
Yeah.
But the interesting thing is that doesn't even matter, because we know what it costs to build. So if you can purchase stuff that you cannot replace, if you're buying it so far below replacement cost, people have to have a place to live. You're going to get rent growth. So even if your multiples don't compress or expand or change in any way, simply by growing your revenue, you're going to create value in the property. And where we are in the cycle is so interesting, because it's a mechanical proposition.
Yeah.
They cannot afford to build. They just
Yep.
can't. So once we blow through nationally as well as Phoenix, I mean, this is not just a Phoenix phenomenon. This is a national phenomenon across the country. Once we blow through that, what next? I think Besant knows that, and he knows he needs to do something about the 10-year. And both him and Trump are being very vocal about that being necessary. I think they're aware. Whether they succeed or not, we don't know. But I think the powers that be realize this 10-year yield is not sustainable. So they're working very hard. Are they going to cause recession in the process? Potentially, to some extent. We don't know. But construction costs are what they are. And in order for builders to come back in, rents have to grow. If rents grow, the values are going to grow. And that has nothing to do, if you take today as a blank slate, nothing changes in the next 2 years. What I'm saying today, I really believe is still going to happen. Rents are going to grow, values are going to grow as a result, even if cap rates don't change or the interest rates don't change. They're going to grow much more if the interest rates and cap rates change. So it's a very exciting time to buy stuff, whether it's 86 value add or new construction or something in between. Very exciting time to buy below replacement cost assets. I think good things will happen when you own something below replacement cost.
Well, that's a great way to, I think, to end the conversation. One of the things I want to encourage our listeners to do is to check out our Substack. As I mentioned, you can find that on Substack if you just type in at ATLalts. You can find the podcast out on Apple and Spotify and anywhere else you get your podcasts. You can always shoot me an email, Andres at ATLalts.com. And of course, visit our website, which is www.atlalts.com. That's how you get a hold of me. If you want to learn more about Ben and Whitehaven, Ben, tell us how we can learn more and how our guests can learn more about what you guys are doing, and to pay attention to, some of the things that you mentioned, construction costs, and how the Fed and the Trump administration are going to deal with the economy, because there's a lot of points that you left us with there that I think we'll have to monitor and see if they play out. But how do people learn more about you and your firm?
So our website is www.whitehaven.com. Very simple, www.whitehaven.com. And my email address is ben@whitehaven.com. That's
Great.
probably the best way. I don't do much social media nowadays. I don't post my stuff. We do have an email list that you can jump on at our website, and we do communicate that way. But really, the website and the email is the best.
Awesome. Well, I would encourage folks that want to learn more to check out their website. Again, that's www.whitehaven.com, and then you can email Ben directly. Join their mailing list to get updated on some of the things they're doing in terms of investments in their portfolio as we get rolling here in 2025. Again, I want to thank Ben Leybovich of Whitehaven for joining us to talk about Phoenix multifamily, the opportunities that Whitehaven and the team are seeing. It's an exciting time. It's an interesting time. Interest in alternatives and private markets is, certainly at record highs. Investors are seeking opportunities to get educated and informed, and are looking for great sponsors. And that's what we're all about here at ATLalts, which is highlighting folks that are on the ground, in the trenches, making things happen, that can provide investors with, attractive risk-adjusted returns. I'd like to leave everybody with an opportunity, to reach out to us. How do you support us? People always ask. Well, send the show if you found this conversation interesting. If you found what Ben had to say, follow him. Reach out to them, but tell your friends, tell your colleagues, tell your clients, and then reach out to us. Again, Andres at ATLalts.com. The website for the podcast is www.atlalts.com, and you can find us out on Substack, where I will post the transcript for today's show, as well as some additional information about Whitehaven for our members. So please join us as a member, where you can get those exclusive member-only insights and information. Thanks so much for joining us today, Ben. I hope you have a great rest of the week and a good spring out there in Phoenix, Arizona.
Thank you so much. Spring is always good in Phoenix, Arizona. You know that. The
Yeah.
weather is
Well, take care.
fantastic. Thank you, Andres, so much. I enjoyed our conversation.
Yeah, it was
Let's do it
great to
again
have you.
sometime.
We'll do it again. Thank you so much.
Thank you, sir.